Hello, everybody. Welcome to Thursday. The S&P 500 was down almost 1.4% today. It gets us into what's called correction territory on the S&P 500, which just means more than 10%. Gets more than 20%. They call it a bear market. The thing I find very interesting about this is if you strip away everything that's happening in the news and why the market's coming down, a 10% downturn is not a big deal. It happens once every year on average since World War II. We just had two giant years in a row. We had a 10% downturn, amongst those two giant years in the summer and the fall of 2023 when we fell 10%. We fell 8.9% last year, almost 10%. So, these things happen. It's not unusual. This is a normal process for the market. However, the real issue is why it's happening. So, for example, in the summer of 2023, when the market came down 10%, it was because inflation was popping back up and there was fear that the Federal Reserve was either not going to lower rates or going to raise rates again and those types of things. In this particular case, the market's very worried about what's going to happen with the tariffs and what have you. I think the thing that break down inside this tariff piece is two things. Number one, we have tariffs. We did tariffs in 2018, $350 billion worth of tariffs. The market dropped 19.6%. The market came back as soon as they stopped doing tariffs fairly quickly. We still have those tariffs. We still hit an all-time high 3 weeks ago. And so, the market dropped 19.6% in 2018 for no reason whatsoever, just based on pure fear of what it would cause. And so far, that's kind of what's happening right now, too. And so the difference between then and now is that they were talking about, 10% tariffs on some products coming out of China. Now we're going after 200% here, 50% there, 25%. All of these big numbers are coming out. Now, the question will be, do we keep those tariffs? How long do those tariffs last? Does Congress turn over to Democratic control in 2 years? And then in 2 years, because Congress can basically take away the tariffs if they want to. Congress has control of tariffs. 4 years down or whatever it might be, those tariffs disappear. How much does that matter? How much does that impact the economy? So there's a real question there. I think it has to be thought through as to what that does. But I think the real issue here, I think that's more concerning, is that the chaotic nature of what's happening is creating a situation where consumers and businesses are sitting down and saying, hey, this is not a time to go buy that car. This is not a time to, we've seen airline reservations drop quite dramatically because people are thinking, okay, maybe I won't do the big travel, kind of wait through what's happening here. We got a survey from small businesses today that came out and said, basically that this was a very bad time to expand your business. As a matter of fact, of the life of that survey, this was the worst response to that question. And so that creates a recession. You combine that with, layoffs at a high degree within the federal government. Again, how does that work out? Do they stay laid off? We keep getting reversals by the courts and what have you. Freezing of government contracts. Do those stay off or not? So all of these things are still in flux. We don't really know for sure what's going to happen with these areas, but that flux and that chaotic nature is creating a chaos situation that the market doesn't like and that the consumers might not like. Now, we haven't seen proof of that. We see some pieces, we see surveys, we see some airline miles dropping down, those types of things. But we're still, waiting for some of the data to see how that happens as far as that goes. We got the CPI inflation data. It was better than expected by a little bit. So, that's a good thing as far as that goes. We'll see how that plays out going forward. Doesn't really include these tariffs and see how that plays out as far as that goes. But I think the thing, to keep in mind here is that we don't know for sure how these things are going to play out. But we are already seeing in our portfolio, the way our portfolio works, we have this big list of ETFs. We're looking for momentum. So as those things come running up, and right now we're looking for the last 50 days. We have 181 ETFs on our list, for example. And if they fall below, if we own them, they fall below the top 40, we move out, we move into what's moving at the top and what have you. So what we've seen moving at the top is consumer staples, all right, and international, developed markets, Europe, et cetera. and high dividend paying stocks. Those are three areas we're seeing moving. In the bond area, we're seeing the long term bonds move quite nicely. I mean, there's a fear of recession. And when there's a fear of recession, that means that interest rates will be going down. And when rates go down, bond values go up. The longer term the bond is, the more it goes up. And so you'll see long term bonds, for example, in the pandemic, when the market was really falling, was going up quite a bit. It's a decent hedge to what's happening in the stock market as far as that goes. So those are the areas that are still doing okay as far as that goes that we are looking at within our portfolio. Now that can continue. We saw that in 2028. We can start moving into more defensive areas, and then eventually those areas aren't doing well enough, and so all of a sudden the things that are at the top are T-bill ETFs, and so we end up with a lot of T-bill ETFs, and we're kind of waiting through for things to settle down as far as that goes. But you do have to give the market some time. You want to stay in the market. We're only down 10%. You want to stay in the market. You might want to stay in more conservative things in the market so that if we do go down farther, you won't fall as much as the market does potentially. But you want to stay in the market in case it turns around. So, you might not gain as much as the market if you're in consumer staples, if the market's coming back very strongly, but you'll still gain something, and you'll gain more than T-bills. You gain more than that money market, very likely. So that's where we're at right now. Just trying to stay where we're at, just get more conservative, wait this out. As things start to deteriorate farther, if they do, then you start to see more things popping up in the list, and you get more and more conservative. And it works. It's a good process. It's a way to go. Be careful not to let emotions take over. I remember, lots of people were very nervous back in that downturn in the summer of 2023. And like I said, the market jumped after that. I mean, really jumped. If you would have gotten out, you missed out on a 9% month in November of 2023. So kind of hang in there, orient things more towards these things that are working as far as that goes. And we go from there because, trying to dissect what's going to happen and how they're going to handle things. And, again, we are in this gap area that I talked about before where we can do all the things that the market doesn't like right away, deportations, laying off government workers, freezing government contracts, and tariffs. We can do all those with executive orders, essentially, although some of those are being done with executive orders that shouldn't be, but nonetheless. The thing that the market would really like is a tax cut, especially on corporations, if they can manage to do it. And that's obviously going to take longer. That's more like a June thing. So here we are in March. So we got to wait through this gap period as far as that goes. And then there's always the possibility that, they change their tune or back off on different things once they start to see. I think, if you start to see a higher inflation number and people really, get upset, they're getting a lot of calls into the Senate, for example, about Musk. Well, eventually, might be getting calls about the higher prices for everything, cars and eggs already running, of course, for different reasons, but just overall food prices and whatnot too. So, we are the best consumers in the world. We have trade deficits with almost every country in the world because we buy more than almost anybody else in the world, and we like to buy things that are inexpensive from foreign countries, and we like to buy things that are unique from foreign countries. Certain wines, or I restore old 1950s Volkswagen Beetles. Most of the products that I can get for those are actually in Europe, just because there's more of them there than there were here in the U.S. And so there's things that are kind of specialty items that are in different areas. But we're a country that has a lot of wealth. We have a lot of income, and we don't save very well at all because we spend. We'll borrow on credit cards. We spend, and so that gives us power in this tariff negotiations because we can raise our tariffs on your products, and you can raise your tariffs on our products, but we're not selling you as much as we're buying from you. And so that gives us, the leverage, and they're maximizing that leverage. Now, are they going to do anything with it? How does that work? Does it settle down into something, more reasonable? I don't know. We'll have to see how that plays out. But that's where we're at. That's the power that we have as a country right now in terms of these tariff situations. Again, I think it's more of an issue right now affecting the psychology of the consumer and the business, growth potential as far as that goes. So we'll have to wait and see how that plays out. But anyway, looking forward to being able to see tomorrow. I'll do, the show. I'll do a summary of what I saw happening this week. And we'll see, kind of break down kind of what's going on as far as that goes. But at the moment, to kind of hang in there, again, we've gotten a little bit more defensive across the board on our portfolio. I would recommend that to anybody. as an alternative to just jumping out of the market as a whole. Just because there can be tremendous gains made if things do recover here, even in the short term, you could see some really big movements upward as the market tries to catch back up and the dip buying really does come in and what have you. Saw a report today that said that a lot of the loss in the market has actually been attributed to these quantitative funds. These are funds that are kind of operating on an algorithm and buying and selling, computerized buying and selling. And most of the selling has come from them. ETFs that you and I buy have actually been getting positive flows. And so the good thing about that is those quantitative models can turn around very quickly and start to buy again with this cash that they've accumulated. Creates more volatility, but it could create an upside very strongly if things do get going. So anyway, we'll look forward to seeing what's going to happen. Look forward to seeing you tomorrow. Thank you very much.